Hey everybody, and welcome back to another video. It's been a little while since we've taken a look at Havest Health and Recreation stock, ticker symbol HRVSF. So I figured we would take a look because they just dropped earnings yesterday on their fourth quarter 2020 earnings. We take a look here. The stock price is $3.23. If you follow my videos, you know the market cap is much more important in my view, and it is $1.19 billion, which in my eyes is currently a steal still. If we go down here on their website, this is just on the investors part. If you click to their homepage and then go to the investors, that will be what you see. And we are looking at the earnings presentation. Over here is the CEO going through the earnings presentation, and he kind of reads it. He did not put it together. You can tell that he is just reading off the sheet. And he is pretty monotone, and it was pretty darn boring. So I will try and save you guys from that and be a little bit more entertaining. So let's get right into it here. Let's skip right through the disclaimers, the agenda, strategic overview. So Havest is a unique opportunity to build sustainable business during the time when a patchwork of laws and regulation limits competition. Havest identifies and invests in core markets. States regulated, limited license markets allow opportunity to build scale, offer significant growth opportunities such as expansion to include recreation cannabis. So the two important ones here are limited license markets. This creates sort of a natural oligarchy since there are barriers to entry and only a certain number of dispensaries or growing facilities are able to produce in the state. So if you are able to swoop in fast as a state legalizes, you can basically already have an oligopoly in the state because there are few other companies with the capital that are able to do this, considering they do not have access to U.S. banking yet. It is mostly cash field and private loans. So their major markets is Arizona. They have 15 stores already, and they have recently begun selling recreationally. So beforehand, the state of Arizona was all medical, but in 2021, they legalized recreationally, and they have been able to sell out of their medical stores, which is great. They don't have to make any new stores and have any more costs because they have a lot of costs with their leases already. So they're able to kind of get a double dip there with medical and recreational in the same store. We look here, revenues increased between 45 and 248. Read that at 248 compared to the fourth quarter between January 22nd and the end of February, prior to insurance stimulus checks. So the number has gone up since because of stimulus checks and seen an increase in products sold. The average increase in revenue was 100%. If you have a triple-digit revenue increase, that is going to be earning you some money over long term in a company if they are able to sustain that, or even anywhere near that. Most locations are even serving an even balance, so a 50-50 ratio of medical to recreational, which is good because once recreational opens, you don't want all of your medical patients to switch over because medical can be a more lucrative field because there's just more intensive care that needs to be going into the products for medical patients. And there are lower margins in the recreational field because most people don't want to be spending a fat check on some adult flowers. We'll put it. Traffic has increased and order size has decreased since the launch of recreational sales. So more people are spending more money in more visits is what I would state this as. So they're not spending as much as when they go in, but they are coming back more and more people are coming into the stores. Results to date have exceeded pre-launch expectations, so they are doing much better than what they would previously thought recreational sales would be in the state. Just their approach in Arizona, they remain committed to its strategy to invest in retail storefronts. Like I said, they have their own dispensaries where they're able to sell wholesalers or other products within the state. Wholesale supply has tightened since adult uses began, given the more limited market structure for retail compared to wholesale operations in Arizona. Havest believes investments in retail should be prioritized. So in Arizona, wholesale is harder considering the tightened constraints. So they are focusing on bolstering their storefronts because they're able to offer a wide array of different companies and still make profit off of it. The Arizona market may reach $2.5 billion, which is already over double their market capitalization at maturity, with an estimated 169 storefronts. Market structure allows for 338 off-site cultivation facilities with unlimited capacity. That one's big right there. Unlimited cultivation capacity means there can only be 338 facilities. They can be however big they want, so it doesn't really put too much constraints on supplies, considering Arizona is mostly desert. And if you want to inhabit it, you can. It would just be a bit out of the way and a far drive. This slide is probably the most important. So if we look here, fourth quarter sales grew 85% year over year and 13% sequentially. So from the last quarter, they're up even 13%. Anytime you're able to increase sales by double digits quarter over quarter is great to hear, because you will be doing just increasing numbers year over year, and it's always good to be increasing your growth rather than declining and slowing down. Growth drivers included sales in existing stores and new stores from contributions of cultivation and manufacturing expansion. Financial reporting has been covered with the US GAAP, so they have been using GAAP. They used to be using non-GAAP numbers for their previous year, which we will get into in a little bit. That just kind of means that there are stricter rules that they have to follow when putting together their financials and stating how much money that they actually made. Fourth quarter adjusted Ebitda, it was $9.1 million under the IFRS accounting. Fourth quarter, this is just who made the Ebitda. Adjusted Ebitda was $16.4 million, which is great considering that they are still a pretty young company and are just starting to focus on profitability. They completed a deal for $32 million, which I believe was Franklin Labs, as I stated in our first video, which I am very bullish on. And they divested, or a divestiture in Arkansas, or Arkansas, however you want to say it, I'm not quite sure, which didn't seem to be a prime market for adult flowers, probably because they didn't have limited licenses, and just because it's not a very big state, or one that they would want to focus on, considering the markets that they are in are much bigger. They repaid $20 million in real estate-backed financing and a conversion of $19.1 million into debt equity. So they're paying down their debts. And they reduced outstanding litigation, settling cases with Divine Holdings and minority owners such as Interurban Capital Group. As we stated before, Interurban was sold to High Times Magazine, and they had a minority ownership of Havest, essentially. So they sold Interurban off to High Times, and they also got back their shares. So they are now have a higher percent of majority ownership of the stock. If we take a look here, these are the quarterly trends. So this goes back to Q4 in 2019, and we can see they lost a lot of money. Since then, it has been on a steady decline since then, except for Q2 in 2020, which was the pandemic. So they had a slight hiccup here, just trying to rework the business model slightly to accommodate for the pandemic. But as we see here, it is getting very, very small as Q4 2020, and eventually, I believe in 2021, they will be a profitable company. And if we look here, the revenue is steadily increasing as they are opening more and more stores in different states and focusing on their key markets and their key states. And we will get into the 4 key states a little bit later. So liquidity, the most important thing in the market and investing. As of December 2020, Havest had $78 million in cash and a whole lot of debt of $265 million. So just a couple months ago, 3 months ago, they had a lot of debt and not too much cash. As of March 26, 2021, they had $91 million in cash, and debt service for 2021 is $49 million, including $10 million convertible notes to be paid with conversion of equity. So they are paying down their debts, which is always a good thing. Capital expenditures for 2021 have been between 35 and 45 million, with up to 11.5 million eligible for reimbursement. So they can get up to, or down to about $24.5 million in capital expenditure if they get full reimbursement. And they expect to meet financial obligations and will make necessary adjustments to meet obligations while pursuing growth objectives. So like I said, growing while trying to focus on profitability at the same time. There's a very, very thin line there of trying to balance both of them. Recent developments in 2021, January, recreational cannabis sales have been allowed in Arizona, like I said, at all stores, which is great. They did not have to make any new stores, which I thought they might have. But that is a very, very bullish point. And if any other state legalized recreationally, they will be able to do the same thing. So they will essentially double their sales, if not more, in the states once they open recreationally, which is just insane. On January 25th, they announced the sale leaseback of a almost 300 square foot cultivation facility. Now, if you are unaware, 100 square feet is huge for a cultivation facility, and most places don't like to go over or even close to 100,000 just because they would rather have numerous smaller facilities to be able to really get into the market and have less travel constraints and supply constraints. They would rather be closer to their consumers and not have to ship it long distances. So that is a huge facility in Florida. I'm not sure where Alachua is. If you do know, let me know in the comments. But they got $23 million for it. They expect to get almost $11 million back in reimbursements. On February 22nd, they divested in 2 retail dispensaries in North Dakota. This is another one that is not a prime market. Nothing against North Dakota, but they are not very populated, not very densely populated at that. So I don't think that they will be buying as much cannabis as other states would be with a higher population. They opened a new location in Whitehall, which is pretty close to me, that I've heard has great things, just like the other ones in the state. And they announced that they will be partnering with Falcon International. They have a deal that they will be taking a 20% stake in the company, or a 10% stake, and have the options to purchase an additional 20%. So they will be a minority owner of 30% if they choose to shoot on that additional option to buy. Their capital allocation, Havest is focused on improving operations across the existing asset base and further penetrating into key states. So this is, like I said, they have a couple states they're focusing on, and they are really just trying to penetrate their markets and get a decent amount of market share, which I think they will, and we will get into. Capital expenditures in 2021 are expected to be 35 and 45 billion compared to 26 in 2020. So they're spending more money on growing their company. The majority of 2021 capital expenditures are slated for our top 4 states, which is always a good sign. You're investing in your top earners, which expect additional investments will yield fast and favorable returns, which I would agree with. Timing and magnitude of capital allocation depends on market conditions and availability of financing. So here, there are currently 123 operational dispensaries in Arizona, and they have 15 of them. If we go to the calculator, 15 divided by 123, that's a 12% market share of just dispensaries. And that's not even sales. I would imagine that they do more than 12% in sales because they're one of the better dispensaries, and they offer just a wide array of products like most others wouldn't, because they have the capital to back it. If we look here, they have 5 different facilities where they are able to grow, and there are 338 potential cultivation facilities. Now, it doesn't say how many are currently open, but 5 is a pretty good start. And like I said here, most of these are not even close to 100,000. The closest one is in 70,000 feet. That is still quite a bit under the 100,000 range. So the one in Florida, like I said, is massive. What they're trying to spend on this year is expansion of cultivation process. Like I said, they only have 5, so they could definitely get more if there's 338 available, and addition of 3 locations, and just get more vertical licenses. So they're able to open more dispensaries and manufacturing facilities. Florida, I think, could be a very, very lucrative market for them, considering this number here. There are only 500,000 qualified patients in Florida. As you may know, this plant is still very illegal in the state of Florida. I'm pretty sure it is a felony if you do not have a med card, if you are found with it in any amounts. And it's just very strict. So only 500,000 people have their med cards. I don't know what the qualifying conditions there are, but it might be harder to get one, or people are just afraid, or like drinking more down there, or maybe it's the nice weather. I'm not quite sure, but this number will definitely increase over time as people are able to get better flower and have dispensaries closer to them, and especially once it is recreational. This number will at least quadruple once it is recreational. Well, the patients will, but the users will, because of just people not wanting to have to pay for a med card or go to a doctor to buy this. Right now they only have 6, and there are 325 approved, but that does not mean that these are opened. Most are not in the state, and it is just a good sign that they already have 6 open and that they are early to the market. The earlier in the game, the better. The customers tend to be pretty loyal when they find something that they like, and they keep going back. Like I said, they have a huge facility in Alachua, and then they have a smaller one in Gainesville. So they are looking to increase this in 2021. Their third state is Maryland. There are 102 dispensaries in the state, and they have 3, so not quite the stronghold like they do in Arizona, but still a pretty good foothold. And there are 19 cultivation licenses and 24 processing licenses. And they have 1 cultivation facility and 2. So they have 2 of the 19, which is a pretty good number. 2 divided by 19. They have a 10% market share there. So that is really, really good. If you look at other companies around the world, they would kill to have a 10% market share. Automotive makers, or especially if you look at Tesla, if they have a 10% market share, their stock price would probably be at 2,000 by now, because I don't think they have even a single percent of the market share, maybe maximum of 3, but they are still quite low in that department. Pennsylvania, this is my exposure to this company. They have 9 open retail dispensaries, and they have the license for 15, so they can open 6 more. If we do 15 divided by 109, that's a 13, almost 14% market share, and that is only going to be growing. I know that they were kind of late to the game in Pennsylvania. I have my card, and I didn't really see them until really 2020, and more in this year, 2021. But they are growing rapidly in the state, and like you can see here, plan to open 6 in the coming year. They only have 1 cultivation facility, which could be a problem. It is pretty decent size at 46,000, almost 47,000 feet squared feet. So they're looking to expand that and the additional locations, like I said. But the Pennsylvania is probably my most bullish state so far. I hope that they will get into other states, but Florida is just pretty early from the legislation and legalization aspect. But Pennsylvania is very, very close to getting recreational, and I think that could be an extremely lucrative market. So if we go to the next slide, this is another financial highlights. We already went through the same exact thing. This is another financial highlights, and this is a very important page. So if we look here, this is the net loss on the GAAP adjusted basis. So if we look here in 2019, they lost $5 million compared to the quarter in the fourth lost 80.19 as a $7 million quarter of 2020. For the year, they have lost just under $60 million, which is still not great, but it is growing or shrinking rapidly from almost $170 million in 2019, which is about 60% decrease. Sorry, I cannot talk there. If you want to get into here, these are the specifics of where they're getting their numbers from. And the other important one was to look at the conversion from non-GAAP. They were not using this in 2019, and they started to in 2020. Here in non-adjusted chart in the Ebitda before tax. So, but it is just a general number on how well the company is doing at spending their money and controlling their operating expenses. So look here, increasing numbers, and normally GAAP basis with their and a bit more kind of creates a strict rule set of what you're allowed to do and where you're allowed to put your pluses and your minuses. So for the year, they have actually made less on a GAAP adjusted basis, but this number is not always one that can be trusted. If we look, I think this is the last slide, shows you who these are, and sitting here, do still have 4 dispensaries in California, which I said in the previous video is not really a market that they're looking to get into, just because a lot of companies already have a strong foothold into, and it is a very competitive market since they have already been medical since 1999. And this is a medical first company. Thank you very much for watching. I hope you enjoyed. If you stayed this long, definitely subscribe and come back. Have a good one.